If you're moving abroad and thinking, finally, no more HMRC, not so fast. Leaving the UK doesn't automatically mean leaving UK tax behind. In fact, if you don't plan it properly, HMRC can and will continue taxing you on income, gains, investments, and even assets you thought were outside their reach. In this video, I'll walk you through how to legally reduce or eliminate UK tax when you leave the UK, the rules, the traps, and the steps to take before you leave. Let's start with the basics. The Statutory Residence Test, or SRT. Leaving the UK doesn't automatically make you non-resident. The Statutory Residence Test determines whether HMRC still sees you as UK resident for tax purposes. I've covered this in detail in other videos, so here's the quick version. It all comes down to three things: how many days you spend in the UK, your UK ties, and what you're doing abroad. Depending on how many days you spend here and whether you've been resident in the previous 3 years, HMRC checks how many ties apply to you. Sometimes one tie is enough to keep you resident. Other times, you need all four. And if you leave mid-tax year, you might qualify for split year treatment. So only the part of the year you lived here is taxed in the UK. That stops you from paying UK tax on income earned after you've left. Alright, now let's go through what to actually do once you've decided to move. First, inform HMRC that you've left. This is the first and most important step. You can do this by completing Form P85 on gov.uk or by post. Once submitted, HMRC updates their records to show you live abroad, preventing confusion about your income and helping avoid disputes later. It's one of the simplest but most overlooked steps. The second is to plan your exit timing carefully. If you leave in April, right at the start of the tax year, you can make the entire year non-resident. But if you leave in, say, February, you'll still be UK resident for most of that year unless you qualify for split year treatment. So, if possible, plan your move around the start of a new UK tax year, which is the 6th of April. Third, keep proof of everything: flight tickets, new overseas job or business contracts, rental or property lease abroad, tax registration or tax ID in your new country, and evidence you've left your UK home or rented it out. These documents are your defense if HMRC ever challenges your residency. Also, update your address with banks, pensions, and investment platforms, and stop using your UK accounts for daily spending. The clearer your paper trail, the less chance HMRC questions your tax status. The fourth is to plan your time in the UK carefully. Keep a precise record of your UK visits, entry and exit dates, total days, and even days in prior years. Remember, the UK tax year runs from the 6th of April to 5th of April, not January to December. There are free apps that can track this automatically, which is helpful if you travel often. The fifth is to cut or reduce your UK ties. This one's often overlooked. The fewer ties you keep, the cleaner your break. Here's what HMRC counts as ties: a home available in the UK, a spouse or children living here, UK work, spending 90 plus days in the UK in either of the last 2 tax years, and spending more days in the UK than in any other country. Now, obviously, you can't always change family ties, but you can control others. For example, rent out your UK home on a proper tenancy. Limit long visits, especially in your first year away, and make sure any business work happens fully abroad, not just done online from a UK address. The sixth, if you're a shareholder or director in a UK company, that's another tie under the SRT. Even occasional work in the UK, like attending meetings, signing contracts, or managing staff, can look like UK-based work. So, where possible, delegate management responsibilities and keep clear records showing your day-to-day operations take place overseas. The next is to make your new tax home real. This is where people slip up. You can't just not live in the UK, you need to live somewhere else. That means having a real address or lease, local bank accounts, utility bills, and most importantly, tax registration abroad. Get a tax ID or residency certificate in your new country. This proves your income base is outside the UK. If HMRC decides your main home and ties are still here, you could still be treated as UK tax resident under the SRT, even if you think you've moved. So, once you move, set up your new life properly. Register for tax locally, keep proof of your address, and open local bank accounts. 8. Before you pack your bags, think carefully about what you're leaving behind. If you own a home, rental property, or business in the UK, this can keep you tied to the UK in HMRC's eyes. Selling UK property after leaving still triggers UK capital gains tax. If you plan to sell, check whether doing so before departure makes more sense. If you're renting out your property, Remember that under the non-resident landlord scheme, your letting agent may need to deduct basic rate tax. It doesn't stop you being non-resident, but it's something to plan for. If you hold taxable accounts, consider realizing gains before leaving or moving funds into ISAs or pensions where possible. UK pensions remain taxable under UK rules, though many countries have double tax treaties with the UK that prevent double taxation, so check your destination's treaty. 9. Understand split year treatment. When you leave mid-year, you can claim split year treatment, so you're taxed only on the period you were a UK resident. You can claim it via self-assessment or through your P85. Simple but powerful if you move partway through a tax year. Finally, get professional advice before you go. Every case is different. The number of days you spend in the UK, how your business operates, or how your pension is taxed all depend on personal details. A qualified tax advisor can structure your move properly and make sure you don't accidentally trigger UK taxes after leaving. Now, how are your income and investments taxed after you go? Once you're non-resident, the UK generally taxes you only on UK source income. That means UK rental income, employment income earned for days worked in the UK, and UK pensions. Foreign income and capital gains are usually outside HMRC's reach except for UK property or certain UK business assets. But beware of temporary non-residence rule. If you return to the UK within 5 years, HMRC can tax certain income or gains realized while you were away. So here's the key takeaway. Leaving the UK isn't enough. You need to plan your exit properly, reduce your ties, document your move, and get the paperwork right. Do that and you can live abroad, earn abroad, and keep more of your money legally. If you found this helpful, hit the like button, subscribe, and let me know in the comments where you're planning to move if you're thinking of leaving the UK, and what's been the biggest tax challenge so far. Now, check out this next video on what happens to your ISAs, pensions, and investments when you leave the UK. Thanks for watching, and I'll see you in the next one.